Good morning, everyone. We're glad you guys could join us today. Looks like we still got quite a few people joining, but we want to get started just to be respectful of your time. My name is Clark Boyd. I'm the COO at Molen Associates. We are a tax and accounting firm that's been in business since 1980 in the Houston area. My co-host today is Kathy Stump. She is our advisory services manager. She's been a business owner, an accountant, a tax advisor. She's done it all. So she is kind of the tax expert behind all of this, helping us business owners learn how to take advantage of the new One Big Beautiful Bill and make it more applicable. So to give you a little bit of background information about our firm, as I mentioned, we are a tax and accounting firm. We specialize in small business ownership, anywhere from startup to, let's call it 20 million. So our goal is to help grow with each of you as a business owner. We are very education focused, we're passionately engaged, and we try to feel like family. So our purpose in holding these presentations is to give you the information just so you have it and you can begin tax planning accordingly. Today is primarily going to be focused on business ownership. So some of you may just be individuals, some of you may not own a business yet, you may want to, you may have a $1 million business or a $10 million business, that's okay. Anything in here, there may be something that applies to you. So even if not everything applies, just try to pick out the pieces that do. So now jumping into the One Big Beautiful Bill. What is it? So this is the new legislation that was just enacted, I think about a little over a month ago now. So it's not quite new, but it still hasn't been put out there very much in the media. We saw a lot of it as I was going through legislation, but now that it's passed, I feel like it's kind of gone away. But this is huge. The last major tax implications we had similar to this were the Tax Cuts and Jobs Act of 2017. So it was a massive change then, and it's just as massive as it is today. So they call it the One Big Beautiful Bill. It really is big. Today we're going to focus primarily on the tax impacts of this bill. There's everything from, there's so many other political agendas going on in this bill. We're not going to focus on any of those. All we're focusing in on is the tax impacts. So this really is a game changer. So this is not just changing the tax scheme, it really is replacing the rule book. But like I said, in 2017, we had the Tax Cuts and Jobs Act that a lot of it was determined to sunset in 2025. So there's gonna be some massive changes. So even though it doesn't sound like there's a lot, this really is huge. So if you don't understand the One Big Beautiful Bill, it's almost like you're playing checkers when you should be playing chess. So you really do need to be understanding these new rules. To show you how close it was at passing, the House passed it by 1 vote, and then the Senate, when they went to vote on it, it was an even 50-50. So it was very, very close from a political standpoint. Then the Vice President had to vote on it before President Trump signed it. So we like to think of tax laws as Swiss cheese. So the goal is we want to find the holes so we can take advantage of them, all those loopholes. When new tax laws come up, sometimes it plugs old holes, but it opens up new holes. So one thing that has been mentioned in the media is this tax reform is for the wealthy. It does not impact just the wealthy. It really does impact everyone. As we go through a lot of these different tax laws, you'll see that a lot of them have higher income phase out limits. So you don't have to be ultra wealthy to take advantage of this. A lot of it's targeted to, let's call it middle class Americans or upper middle class. But there's a lot even for lower income households. So just because you're upper income or lower income doesn't mean this doesn't apply to you. It really does apply to everyone. Everyone that pays taxes needs to understand this bill, because even something as basic as the tax brackets and the tax rates, that has all changed. So nothing fundamental, but it is a huge impact. I think we're going to see pretty big tax savings across the board. One other thing I'll mention is this is like an iceberg. Tax legislation, when it comes out, you're like, oh, I got this. But there is a lot more going on below the surface. So you can take what we've read here or what we'll present today, but there'll be a lot more that you can keep learning and applying to you. The important part is you want to be proactive and you want to start planning now. We've got a couple of everyone engaged, see where you're at, see how basically what you understand already versus what you don't know. So I'm going to put up a couple of polls. Sorry, I got Siri going off. So starting off, how confident are you in your understanding of the One Big Beautiful Bill? Are you very confident, somewhat confident, not very confident? And we'll use this to kind of tweak our material as we're going through to know who knows what, kind of where you're at as an audience, because there's not a great way to get your feedback. One other thing while you guys, we do have a Q&A down at the bottom of your screen. There should be almost like a little bubble box with a question mark in it. If you click that question mark, you should be able to ask us a question. It won't show to everyone, it'll just come to us. So if you answer it as we're going through, we're more than happy to answer questions as we go. If we can't get to it now, we'll open up for Q&A at the end. If there's something that's too specific, we need more context, we may need to do a follow-up call with you just to answer that directly. But here are the results so far. That should pop up on your screen. So it looks like most people are not very confident. That's good. We can give you a lot of information today, but some people are somewhat confident. One other question I wanted to start with. How do you typically stay informed about major tax law changes? Because this is also really important. Not just right now with the One Big Beautiful Bill, but in the future. Because tax laws are always changing. Really, they change every single year. Okay, I'll keep that one shorter. So it looks like most are between a professional advisor or some sort of online research. I'm glad no one said TikTok or social media. That's always the most entertaining when people get advice from TikTok, because it's usually not right, or it is right, but just in the wrong circumstances. And then one more. What are your biggest challenges with tax planning? Is it understanding the tax laws? Is it following through with the plan? Is it keeping your records organized, or is it something else? So we've got a couple of people asking if today's slides will be shared after the presentation. Yes, we'll provide both the slides as well as the recording. Actually, immediately after this presentation, there will be basically an automated email that will be sent to you. That will have the link to where the presentation will be linked. It'll take longer than 5 minutes to get there. Normally within an hour to 2 hours, we should get it up online. It just takes time to process. But those, yes, those will be provided online. Okay. So then for that question, understanding tax laws, looks like most people, the difficulty is understanding the tax laws. So that's perfect that you're here today. We can help you understand that. So jumping into the content here, we're going to start, really today's broken up into two main segments. We'll start with the business specific changes, and then we'll go into some individual specific changes. And as a business owner, you file both a business return and a personal return. So all of these should apply to you. Like I said, some may not based on your facts and circumstances, but we wanted to start with bonus depreciation. So kind of starting with ground zero, bonus depreciation is the ability to expense an item in the year that you buy it faster than what you would in a normal given tax year. So let's say you buy a home. Normally it's going to be 27 and a half years for a residential home, 39 years for a commercial property. You can expedite that faster with bonus depreciation. Or a lot of times people are buying a vehicle. Okay, how do I write off my vehicle? There's lots of different ways, but bonus depreciation lets you do that faster. So historically, I'm going to skip ahead a little bit. I'll come back to this. So here is what it had been historically. So with the Tax Cuts and Jobs Act of 2017, we did have 100% bonus depreciation, and then it was scaled down. It reduced by 20% each year. So right now, if the Tax Cuts and Jobs Act, if the One Big Beautiful Bill were not passed, we'd be at 40% bonus depreciation, but instead it is now at 100%. So that's a huge, huge, huge thing. If you're buying equipment, if you're buying buildings, any sort of assets like that that can be bonus depreciated. So as a qualifier, this 100% bonus depreciation qualifies for items after January 19th, 2025. Kind of a weird date, but that happens to be Inauguration Day, so got to throw those dates in there somewhere. This replaces the entire old phase-out schedule. So a couple of things that help here. This is now permanent, meaning it will be like this at 100% indefinitely. There's no more phase-down schedule. I will also say the word permanent when it comes to tax laws is not always permanent. It just means it's permanent as long as they don't change the legislation. A lot of laws they'll set a sunset where it'll phase out and we'll go back to the old laws, or it'll do a phase down schedule. But a lot of these new rules were set as permanent items. So a couple of tax planning things you can focus on here. You can change the timing of the purchase of your assets. So if you have, for example, variable income, you have some really high years, some really low years, you may want to purchase assets and depreciate them in really high years. So that way in lower years, you kind of stabilize that tax debt. If you're a pass-through entity, you may want to review bonus depreciation to see how it can offset your QBI. Because if you're bonus depreciating too much, your QBI and your profit will be lower. So it gets very complicated. We'll get to QBI in a little bit, but that's a really big one, is balancing out your QBI deduction with your bonus depreciation. Also balancing out 179. So 179 versus bonus. With 179, it allows you more control. You can select certain individual assets rather than an entire class of assets. Kathy, you may want to jump more in on that one, but I'll add one more comment before I turn it over to you. 179, it cannot take you into a loss, but bonus depreciation can. So for some of you, that may be really important. This is also huge for estate planning. If you have a large estate and you want to, basically, if you want to lower the value of your estate, you can bonus depreciate certain assets and bring you down below that estate tax threshold. So this is huge for future planning. It may not be super important for 2025, but as you're doing a 2, 3, 4, 5-year business forecast, bonus depreciation planning is huge. Kathy, any notes from you on that one?
I think the biggest thing to always make sure you consider is that this is a year-by-year decision, whether you do take bonus depreciation or Section 179 on new purchases. If you have the ability to go back and forth between them, sometimes one makes more sense in one year, and then the next year it might make more sense to use the other method of depreciation. They're not set in stone. Once you choose one, you don't have to keep with that the whole, the rest of your business life. But you can make what's ever more advantageous for you for that year, you can select during that year. The other thing that's important to remember is that bonus depreciation and Section 179 do not apply to real estate, except for certain kind of exceptions to that rule. Improvements to leases can be, even though they might be a real estate component, they can be bonus depreciated or Section 179. We'll go into cost segregation a little bit later, but I think the important thing from overall standpoint is just to realize that you can select one or the other, and bonus depreciation can actually take you into a loss situation. So let's say you have a $50,000 income for the year and you purchase equipment of $65,000. At that time, you would want to select bonus depreciation if you need that loss to be in the current year, because bonus depreciation can take you into a loss where Section 179 cannot.
We had a question on what is bonus depreciation versus Section 179. So these are different areas of the tax code that do almost the same thing. So a lot of people get them confused. Bonus depreciation is a special tax incentive that lets you decide what percentage or cost of that qualifying property that you can essentially depreciate immediately that it's placed in service, rather than depreciating over several years. So at Section 179, you can expense the property up to a certain annual limit. So there's just different rules. It's different parts of the tax code. As we mentioned, there's different rules, but it almost does the same thing. So I would, if you're interested in Utilizing bonus depreciation or Section 179, I would highly recommend working with your tax advisor to decide which one's best and in which years, as Kathy mentioned, because it can vary. One other thing that I forgot to mention is planning for future sales. So let's take a vehicle as an example. If you purchase a $50,000 vehicle this year, you say, oh man, my income's super high, I want to reduce it. Let's say I'm doing $200,000 of income, and I only have $50,000 of expenses. My taxable income is now $150,000, but I purchased a vehicle. Okay, now I can bonus depreciate that, or I can straight line depreciate it over, let's call it 7 years. If I bonus depreciate it this year, maybe I take another $50,000 of a deduction. But if I go to resell that vehicle in 3 years, I have to reclaim that depreciation recapture. So then you may be paying taxes on something you got as a depreciation expense a few years prior. So don't do this willy-nilly. Don't do it willy-nilly. Don't do it just because you want to get that short-term gain. Tax planning really should be a longer-term forecast to make sure you're not just avoiding tax in the short term. And sometimes that's beneficial because your money can do more for you now and you can reinvest in other assets. Sometimes it is beneficial, but a lot of times people forget sometimes that depreciation, it is not good long-term. Couple of things having to do with Section 179 and bonus depreciation. If any of you are real estate professionals, so in order to qualify for real estate professional status, you need to have more than 750 hours in service and basically in real property trade or business per year, and more than 50% of your professional services must be in real estate activities. So whether that's development, sales, leasing, brokerage, you name it, you have to have material participation in that activity. So that can unlock a little bit more. So you can take some of that depreciation and it can go against your active income. So if you have a high W-2 and you want to offset some of that income, that's a great way. For rental income, it can be defined as active income or passive income. So the way we've defined that in a very simplistic way is active income is if you're flipping houses, active real estate commissions. If you're a real estate professional, your rental income is active. This would be subject to self-employment tax. If your real estate income is passive, this would be most people's single-family homes, commercial home, rental properties. If you're not a real estate professional, if you're not flipping houses, and passive loss limits would apply. So that's where cost segregation can be really important if you are a real estate professional or you have active real estate income. This cost segregation, doing a breakdown here, normally, like I said, it's 39 years or 27 and a half years for that asset life, and it breaks it out into different categories. So let's say the building structure is that 39 for commercial, 27 and a half for residential, the foundation, the exterior, the HVAC, the plumbing, those hard assets. But then you can break it down into 15-year or 5 and 7 years. So any of the cabinets, the carpeting, the flooring, the decorative, that's what you can expedite into bonus depreciation. So taking that one step further to give you a real example, if you were to take a building that's worth, let's call it $5 million, just to round off, and straight line depreciate it over 39 years, that's $338,000 straight line depreciation. However, if you were to bonus depreciate that same asset, you can now do $2 million of depreciation. So you can see how much that would save you in taxes in year one. And most of the time, if you're going to buy a building of that size, you're not looking to flip it in 2 to 3 years. So a lot of times this cost segregation study can be helpful. If you own a building, if you own large equipment, or you plan on doing so, please let us know. We've got a really great cost segregation person that can help with those studies. This is actually his slide, so thanks for letting us borrow that. But it is super helpful. We already went over the phase out schedules here. Like I said, it is permanent at 100%. But the fun fact here is that 100% is based on when the building was built, not when it was studied, that determines the bonus depreciation rate. So even at 40, 50, 60%, it can still be beneficial, but now at 100%, it gives you a lot more options. Okay, with QBI, just by Let me do a quick poll real quick. So of the people on this webinar now, how do you, or I guess, do you annually maximize your QBI? Because we work with a lot of clients on this. And I guess is a lot of people aren't familiar with QBI. And of those that are, there could be dollars left on the table if you're not maximizing it. So it looks like the large majority is no. So this will give you something really good to work on. If you own a business, this is a huge deduction. So Section 199A, or Qualified Business Income Deduction, is a 20% deduction based on your business profit. So let's say your business is doing $2 million of revenue, you have $1 million of expenses, you're left with $1 million in profit. Of that $1 million in profit, it is a 20% deduction off the profit before you're taxed on your personal return. So it's a really great way to reduce the taxes without having to spend more money. So I would say it's the best deduction, because usually if you want to get a deduction, you have to swipe your credit card, you have to buy something in order to get a deduction. But with this one, you're really getting a deduction on the profit. So super, super beneficial. This is not new, but as I mentioned, this is one that's set to sunset. So even a business doing $100,000 in profit, this is a $20,000 deduction. So this is, when we say this is huge for small business owners, this really is huge. And this can be for Schedule C filers, S-Corp filers, partnerships, any of those pass-through entities. It is now made permanent. So they also added a $400 minimum floor, which is helpful. But that really only applies if you're a very, very small business doing, I think, $2,000 or $3,000 or less of profit. So if you are a C Corp filer, this may be worth reviewing your entity structure to see if it's worth changing over from a C Corp to an S Corp. A lot of people, when they changed the corporate tax rates for C Corp back in 2017, I believe, a lot of people moved to S Corps, even though this wasn't permanent. But now that this is permanent, I think we'll see a lot more people moving from a C Corp to an S Corp, just because this is the way that they give small businesses a little bit of a credit with that corporate tax break. New phase out rules. This allows you more breathing room if you want to do retirement conversions, deferring income. So you can get the full deduction up to, for single filers, up to $272,000, for married filing joint filers up to $544,000. So that's a pretty big increase from what it was previously. So watch your retirement conversions. If you're doing backdoor Roth, mega backdoors, don't mess up your QBI limits. So if you, let's say you convert $100,000, but your income's already $300,000, now you're over that threshold, you may lose or phase out of this deduction. It may be worth staggering those retirement contributions if possible. We talked about the $400 QBI deduction, and then coordinating this with your QBI and Section 179. So as I mentioned, the Section 179 and bonus depreciation reduce your profits by taking that expense on basically business assets immediately. This then takes that tax on that profit and reduces it. So it's two different types of tax law, but you can use them in coordination. So if you depreciate more assets, that means your QBI is less. But also, if you're above the threshold, you can depreciate things to get below your threshold and reactivate QBI. So there's some pretty complex planning that goes on here. So don't forget to think about QBI and bonus depreciation, how they interact with each other. One other note on QBI specifically, but also a lot of these other tax laws, watch out for state conformity. So not all states recognize QBI at the state level. It is across the nation at a federal level. But if you're not in Texas, this could be really big for you on your state tax return. So just check with your tax preparer or accountant. Kathy, anything you want to add on QBI?
I think QBI is one of the better deductions that's been around for a long time, and everyone was really watching this really closely because the loss of this would have been a huge detriment to business owners. And it's just nice to know that it's now permanent. Like Clark said, permanent's relative speaking to the IRS code, but it is, we're not looking at staring at the face of a cliff that we're about to come over for Section 170 or 199A again. And the nice thing about it, and the thing that you always need to keep in mind as you're thinking about tax planning, your year end, these things are all kind of puzzle pieces, and they do need to kind of integrate with each other. You don't want to do too much of one to the detriment of the other. So you really do need to kind of understand how they all work together. And, you know, your tax professional can help you with that. It is a planning tool, though. It's hard to go back, and, you know, once you get past the end of the year, you really, you know, it's kind of set in stone. Then what you've done is what you've done. So just make sure that you're considering that when you do year-end tax planning, and give yourself enough time to make adjustments if you need to make adjustments to come out with the best result.
Perfect. We were talking yesterday, and one of my favorite quotes is, an ounce of prevention is worth a pound of cure. That is especially true with tax planning. There's only so much we can do historically when we file your taxes in, let's call it March, April, May, whenever you like to file. There's only so much we can do after the year is over. So, but if we can plan ahead and coordinate your distributions, your 199A, your Section 179, your bonus depreciation, all of these business decisions really come into play. So with a lot of our business owners, we like to meet 4 times a year. Maybe beginning of the year, tax preparation, kind of summertime to do a mid-year check-in, and then end of year for those last minute tax moves. You can figure out, hey, what has my business done? Was it more profitable? Was it less profitable? Should I pull the lever on 179? I'm sorry, on Section 199A, balancing that out with my bonus depreciation. Do I need to buy a vehicle in December to offset that? I need a new vehicle anyways, but I was going to do it next year. Is it worth doing this year? So the larger your business gets, the more important that gets. But even businesses we see doing $100,000 to $200,000 in revenue, it can be very advantageous, because at that stage, an extra $5,000 in taxes is huge. And a lot of these tax laws can make that difference. This next one here is Section 1202, Qualified Small Business Stock. So this is a largely underutilized, and it's often skipped. This is not just for large tech companies that are going public in Silicon Valley. It can have a lot of different applications for companies like HVAC, electricians, doctors. You just have to be sure that you're on the qualified list. So last year, you could get a 100% exclusion for a company sale of up to $10 million, or up to the 10 times the owner's basis. After July 4th, when this law is passed, when the One Big Beautiful Bill was passed, you could do, if you issue that stock, you can get up to 100% capital gain exclusion on up to $15 million, or 15 times the owner's basis, whichever is greater, as long as you hold it for 5 years. So it's a prorated amount. You still get benefit even if you hold the stock for less. But in order to qualify, that needs to be under $75 million of assets. It used to be 50 million. So the number of assets has jumped up, and anyone that was issued the stock before July 4th, 2025 would be under the old rules. So this one, like I said, it's largely underutilized. It can be very, very advantageous if you plan on selling a company. Kathy, is there anything you want to add on qualified business stock?
No.
Okay. If you have questions on that one, feel free to let us know. We'll move on to R&D expense reduction. So this one it's another weird date. You can see it's December 30th, 2024. I don't know why they do this, but they like to keep things interesting. So any costs incurred after December 30th, 2024 may be expensed immediately, and you can also get retroactive relief, or if you're a small business, back to 2022. So you can amend them, but it may raise a red flag for an audit. But there's different ways to do that. The deduction limit was raised to 2.5 million with a phase-out threshold at $4 million, and that's indexed for inflation. So the business limits are reversed back to the 2022 rules, meaning you can now deduct to 30% of EBITDA, not just EBIT. There's a cap for corporate taxpayers that's been made permanent, and if you have losses above the cap, it carries forward with the net operating loss rules. So if you are a business that takes advantage of the R&D credit, or I'm sorry, the R&D expense deduction, this is huge. It's definitely worth taking advantage of. Anything to add on that one, Kathy?
Yes. The important thing to remember about R&D is to make sure that what you're doing does qualify. There are procedures in place to be able to document that, and it is highly audited. So you do want to make sure that when you're going through and determining what your R&D expenses actually are, that you're documenting it properly. And as long as you do that, though, it's not to say because it's highly audited that you should totally avoid it. As long as you do your proper documentation and, kind of follow their guidelines, it is a huge deduction. And the other nice thing about it is on top of the deduction, if you're doing R&D for your business, it can help your business going forward. And, if you find a new process that helps you cut costs or helps you increase output, those sort of things. So it's not just a deduction that you get to take. It can also benefit your company years down the road.
Perfect. Thank you. One last, yep, so that was our last business deduction we'll go over. There's a lot still to go over on individuals. So feel free to keep those questions coming as you have questions that apply to you. This first one here is qualified opportunity zones. So this has been made permanent. If you are a real estate investor, or if you have capital gains that you want to defer or get rid of, this is a very common question we have. This was one that after 2021, we just kind of got used to this being gone. The benefits weren't as beneficial, but this is now reinstated. So the original plan was money that was invested that accrued capital gains. If you invest it in an opportunity zone, you had an enhanced step up in basis. If it had basically an approved area, whether it's rural or a special area that needed help. There's still a 180-day investment window that applies. So after you sell that asset, you want to reinvest it, you only have 180 days, and you can defer capital gains for up to 5 years. However, if you hold it for 5 years or longer, you get a 10% step in basis. If you hold it for 10 years or longer, it becomes fully tax-free, and post-deferral gains are also tax-free up to 30 years. So a lot of real estate investors, they'll do a 1031 exchange to keep that the capital gains progressing, and then they get the step up in basis upon death to pass to their dependents. This is a way you can do that before death. So it's huge, huge, huge if you've got capital gains that you want to roll up and either defer or get rid of completely. The initial improvement requirement was reduced to 50%, so this is easier to do, but they did increase the opportunity zone eligibility requirements, so it's harder to apply. Before, this is kind of like the wild, wild west. If you find an opportunity zone, you invest it, you just put it on your tax return, but the reporting is now required, so it's much more restricted. So more beneficial, but a little harder to do. Make sure you're staying on top of the compliance with this, because the penalties for non-compliance are there. They're pretty big. There's also going to be more opportunities at the state level, not just the federal level. So this could open up more opportunities that we didn't see before. Going through a real world example. So if you take $1 million, and let's say you invest it in 2027, because that's when this will become really effective again. You take $1 million, capital gains, reinvest it, you would be saving about $238,000 of taxes, assuming 20% capital gains rate and 3.8% net investment tax, and you could defer that. If you hold it for 5 years, you defer those capital gains and get a 10% step up in basis. But if you save it for longer than that, going up to 10 years, it's tax-free and you get long-term gains excluded as well. So you're talking about $250,000 capital gains completely avoided on that investment. So huge, huge opportunity. Think about what you could do with $250,000 to reinvest either into your business, another investment. There's a lot here. Kathy, anything else on that one you'd like to add?
I think the other thing about talking about states, one thing is more under the control of the states now. They're going to be able to select opportunity zones within their states. And one thing that they have mentioned that would be beneficial to taxpayers here in Texas is that some of the opportunity zones, because usually like areas that are depressed economically, just have a lack of people, a lack of resources, a lack of infrastructure. But one thing that they have opened it up for is areas that have been kind of decimated by natural disasters, like in Texas for Hurricane Beryl. Texas will have the ability to look at those kind of things if there's something that really just made a big impact in a certain area because of the hurricane, that can also become an opportunity zone. So it gives the state a little bit of kind of control over what they can add to that. It gives the residents of the state an opportunity to invest in rebuilding their state.
Yeah, this is one that, like I said, was huge in 2020, 2021 before it was kind of less effective or removed. But it'll be really big again, especially with even state opportunities like Kathy mentioned. So definitely take advantage of this if you're planning to sell an asset and you have some capital gains you want to roll over. Sorry, my screen's not switching. There we go. SALT cap. So I think all of us here in Texas are very familiar with the SALT cap. So SALT is state and local taxes. So this is your property taxes, your mortgage interest, all of those types of things. In Texas, we don't have state income tax, but if you live in a state where you do have state income tax, that's where this would apply. The cap will be raised from $10,000 to $40,000. And this is only from 2025 to 2029. It is scheduled to sunset back to $10,000 in 2030. One other thing to note here is there is a phase out limit for incomes over $500,000, but it does not phase you out below that original $10,000. So let's say you're earning $300,000, you've got a mortgage of $750,000 in the state of Texas. I can almost guarantee you'll be above that $10,000 just in property taxes alone. And if you add in your mortgage insurance, you're well above $10,000 annual. So this will be a huge deduction for you if you itemize. Like I said, super helpful in high state tax and high income tax states. Going through an example here, if you're right around that threshold of, let's call it $500,000 of AGI versus $600,000 of AGI, using your bonus depreciation, making sure you're not doing too many retirement distributions, managing QBI, all of that's where this comes into play. So if you're trying to qualify for this SALT tax deduction, let's say you don't do basically you're in the exact same situation, you're itemized, same house, everything, but you have $100,000 more of income. This SALT cap deduction of $40,000 moving to $10,000 creates an increase in tax of $45,000. So you're only going from $500,000 to $600,000, but literally 50% of that, or 45.5%, is being taxed. So this is where tax planning is really important, making sure you know what, let's say an incremental dollar is going to cost you 45 cents. You may say, you know what, I don't want to do that retirement conversion. It's not worth it this year. If you're down 100,000, sure, that's still only, let's call it 24% at that rate, but 45%, no way. So make sure you're doing some tax planning when it comes to SALT tax. Anything else on that one, Kathy?
I don't think so.
Okay. There we go. Okay, couple new deductions. Higher standard deductions are made permanent. So this is another one that was set to sunset. This doesn't sound big, but pre-Tax Cuts and Jobs Act, if we look at the tax rates and the standard deductions, in 2017, it was what, $10,000 to $15,000, and we're up to $31,000 now. So to drop off, let's call it $20,000 in standard deduction, that's huge. So that's an automatic deduction you don't have to do anything for. With the tax brackets, these are also set to extend, not sunset, because let's say you're at the 10%, 12%, 22, 24, 32, 35, and 37. All of those were set to increase, but also the income brackets of those were they're now set to increase. So even if you make the exact same amount of income this year as last year, your taxes have gone down. So it doesn't sound that exciting, but because these tax rates have been extended and the brackets are increased and indexed with inflation, it really has a huge savings. I think we figured someone making $75,000, it's going to save at least a few $100s in taxes just with that alone. Nothing else considered. With the child tax credit, this one's pretty simple. It's going from $2,000 to $2,200. This is another one that it'll be indexed annually, and it's also a refundable credit. So I'll take a second here to differentiate between a credit and a deduction. A deduction is what we've been talking about for a lot of these so far. If you spend $1, you get $1 less of income. A credit is directly offsetting the amount of tax you're paying. So the way taxes work is you have your income minus expenses equals your profit. And let's say your profit is $100,000 and your taxes are, just for round numbers, we'll call it $20,000 in taxes. If you have a $5,000 deduction, that's going to take your profit from $100,000 down to $95,000, which means your taxes maybe go from $2,000 down to $19,560. Not a huge drop, but it's a good drop. A direct $2,200 of tax credit on your personal return offsets that $5,000 of tax down to roughly $2,500. So a huge thing if you can get a credit. For itemized deductions, there is one mention here. If you're at the 37% tax bracket, there is a reduction of your itemized tax deductions by 2/37. And that only applies if your income is higher than $751,000. So it won't apply to a ton of people, but just worth mentioning.
I think the other important thing to, I'm sorry.
Oh,
I think the other important thing to remember about the changes in the standard deduction and the rates is you might not see a big impact from comparing this year to, just say, comparing 24 to 25 or 26. But where you really would have seen it, because this was what they call a cliff. When we come to the end of 25, it was just could have been completely gone, and we would have reverted back to what we had in 2017. So the important thing to remember is that you are saving money, and the tax impact of that would have been huge if those things if that cliff had happened and we all went back to the higher rates plus a lower standard deduction. That comparison is what you really need to look at to realize how much this bill really has saved you.
Yeah, so it doesn't sound that exciting, but from a numbers on the paper, it is a huge, huge difference. The next one we'll go into is the senior deduction. So this is a $6,000 deduction for taxpayers over 65. So if you are over 65 and your spouse is over 65, that means you each get a $6,000 deduction. There is a phase-out limit for single filers over 75,000 or married filing joint over 150,000. This is also set to sunset in 2028. So another plug, be careful with those Roth conversions. We have a lot of people in these couple of first years in retirement, they want to do Roth conversions because they are not working anymore. They're trying to get those conversions over so they don't have to pay taxes long term. Be careful. That's a pretty big deduction. You don't want to lose that deduction just because you flippantly decided to do a Roth conversion and didn't think about the consequences. So one other thing to note here, there was a lot of misconception about Social Security being taxable or not. Social Security is still taxable the same way it was, up to 85%. There were no changes there. The Social Security office even sent out an email to about 60 million people stating there would be no taxes on Social Security benefits. It is not true. It was basically just a misunderstanding of how this deduction would be applied. This is their way at reducing the amount of tax on people receiving Social Security, but it does not impact the way your Social Security is taxed. So You can't believe everything you see in the media or that comes to your email, but still a very nice deduction for anyone that's 65 or older. For charitable deductions for non-itemizers, if you don't itemize, you can still deduct $1,000 for a single filer or $2,000 for married filing joint. So this is also made permanent, and there's a 0.5% floor for charitable contributions. So if your AGI is $100,000, you'd have to donate over $500 in order to use those. So nice little thing that's on top of the standard deduction, or in addition to the standard deduction, that's something you could use. For tips and overtime, if you're a restaurant worker, someone that gets a lot of overtime, or you're getting tips, this could be hugely beneficial. I will say this is only valid from 2025 to 2028 as it currently stands. So this is one that will be scheduled to sunset. You can deduct up to $25,000 in tips and $12,500 in overtime pay as a single filer, or $25,000 married filing joint. So there's also some income thresholds, phase outs for this. It's up to $150,000 for single filers and $300,000 for married filing joint. Like I mentioned, this is huge for restaurant filers. Be sure to track this if you're one that will be qualifying for this. My guess is we're going to have a lot of employers doing this incorrectly, and it's going to be kind of a mess come in year end. But just be aware that you may need to come up with some good records yourself. For U.S. auto loan interest. So this is only qualifying for U.S. assembled vehicles purchased between 2025 and 2028. So once again, it's a sunset. You can deduct up to $10,000 per year for your vehicle loan. Also has income thresholds here for phase out. Anything to add on these ones?
I don't think so.
Okay. Another one you've probably seen a lot in the media is these Trump accounts. So from 2025 to 2028, you can basically a $1,000 deposit per newborn will be given to any new children born. So parents can also contribute $5,000 per year tax deferred, and it grows tax free. But when you distribute it, you then pay taxes on that distribution, kind of like a traditional IRA. So the way this is broken down is there's also, if you're an employer, you can contribute to an employee's Trump tax account. So don't know quite how that will work yet, but on the distribution side, if the recipient, once they turn age 18, they can take out 50% for qualified expenses. After age 25, they can take out 100% for qualified expenses. And by age 30, the funds can be used for any reason. So that's a way that you can avoid early withdrawal penalties. As I mentioned, it's very similar to a traditional IRA. So this is just another way that you can use it as kind of a savings vehicle for your children. So if you got a 529, if you're doing a Roth IRA, this is another option that you can do with them. Non-qualified expenses will be taxed as ordinary income, and the qualified expenses are counted as long-term capital gains. So for a lot of people, if you're a higher income earner, that's a pretty big deduction. If you can go from, let's call it a 24% tax bracket down to 15% long-term capital gains, that's definitely a win. We talked about mortgage interest. 529's also got an upgrade. You can withdraw up to $20,000 per year for elementary or high school expenses, as well as an expanded list of eligible expenses. This now includes programs outside of the traditional college route. So think trade schools qualify. If you're going to become a CPA, an enrolled agent, you want to go into taxes, give us a call. But you can also you can deduct that type of education and post-secondary certification type work. The last one I'll mention here is the estate and gift planning under the One Big Beautiful Bill. They have increased the exemption. So it's now $15 million per person starting at 2026. So that means if you're married filing joint, that is a total of $30 million per married couple. So there's been a lot of talk about that threshold being reduced. So it's very comforting to a lot of people that were on the threshold or even above what they thought it would be. That's being expanded. That also gives you the ability to focus on strategic giving. So if you're in a high net worth family, you can consider the lifetime gifting limit to basically to leverage the expanded exemption. Anything else on these ones, Kathy?
No.
Okay. So I put together this cheat sheet here. Taxes are not an exact science. A lot of times people think, oh, accounting is so black and white. In reality, accounting is what goes on your profit and loss. We take that profit and loss and turn it into more of the art. It's not a black and white type thing. So you may not qualify for every deduction or every credit that you think you may qualify for. But the tax return is kind of fluid. Sometimes there is black and whiteness to it. A has to go under A, B goes under B. But with these credits and deductions, I wanted to break them down into what income levels we thought they would be most beneficial for. So for example, if you're under $150,000 single or $300 married filing joint, you may be taking advantage of the overtime or tip exemptions, the child tax credit, the chump accounts, the senior deduction. Under, let's call it $400,000, that's where the SALT cap really comes into play, 529 plan front loading, optimizing your mortgage and education deductions. You can layer charitable contributions. So we went through and did this. As I mentioned, at the end of this, we'll send out the slides as well as the presentation. So you'll get that via email. So you may be making less than 300,000 married filing joint, and some of these higher income ones still qualify for you, but I wanted to put this just as an area that you can focus on. As I mentioned, you're going to get the slides. If you're interested in a one-on-one review, we're doing One Big Beautiful Bill consultations for 50% off of our normal consultation rates, just as kind of an offer to help you learn these. It's super, super helpful. So if you are interested in taking advantage of a one-on-one, please mark yes. We'll reach out to you specifically. For everyone else, we'll still reach out to you to see if there's anything we can answer, anything we can help with. Just remember that tax planning really is kind of like a GPS. Navigating the tax laws is like using the GPS, and the One Big Beautiful Bill is like a major road update. If you don't proactively update your course, you're going to miss paths faster. You'll run into roadblocks. Proactivity really is your recalculator. So use the consultations as well as quarterly consultations if you're a business owner to help stay on the best road for your business and stay ahead of any financial situations you may run into. Remember, if you want to do planning with us, planning with someone else, some of these laws go into effect now, others go into effect in the future. Some expire, some sunset, while others are made permanent. And this is extremely important to build into your tax and financial plans. Whether you use us or someone else, be sure that you're working with a proactive advisor. A reactive advisor is like putting a firefighter after the blaze has started, but a proactive advisor is like having a safety inspector who comes in and inspects your building before the fire starts at all. So we really do try to be more proactive when it comes to these items. So if you have any other questions, I'm going to go through and see if there's any in here that we haven't answered. So one of the questions here, and Kathy, if you want to answer these ones, I'll turn them over to you.
Okay.
Are you saying we can no longer take losses due to national disasters?
No, not at all. The casualty losses did not change. It's just that the addition of for the opportunity zones, the state can have the opportunity to say that because of the national disaster, it's designated as an opportunity zone for investment purposes and those gain deferrals, but it does not change anything for the deduction for the actual loss itself if you suffer a loss to your personal property or to your business property.
Okay, the next question here, is the overtime exemption only for the restaurant industry?
No, it's any industry that is typically a tipped industry. If you are an Uber driver, for example, you often get tips. If you are in, coffee shops and those type of things, anything that's a typical tipped industry that you would receive tips for, it does qualify. It's not just restaurants. Perfect.
Another question here. if I'm looking to start a business, what type of entity would you recommend setting up now under these new laws?
The type of entity is not just about these laws. These laws will affect your decision, but your overall decision is impacted by what kind of business it is, the volume that you expect to happen, your involvement in it. Is it going to be a passive type business, or are you going to be involved in it day to day? We'd be happy to look at that with you on a, in a consultation and talk to you about the how you would set that up depending on what your specific criteria are. Or we can send you out an email if you can follow up with us with just a little bit more clarity on what kind of business it is, what your involvement in the business is, and how you anticipate the growth to happen. Is it going to be a slow growth, a fast growth? Are you ready to start right away? Are you starting, in a year or two? There's just a lot of variables in that.
Okay, and we've got one more question before you kind of wrap up and conclude. Is the QBI only for S-Corps, not C-Corps?
It's not only for S-Corps, but it does not apply to C-Corps. The QBI can be on a Schedule C. Partnership pass-throughs can also qualify you for QBI, depending on wages and assets and pass-through income. But C corporations, and that was part of the rationale for doing the QBI deduction, that C corporations lobbied very strongly to get their corporate tax rate reduced. They are at a flat rate of 21%, and that has not changed. So they are not allowed the QBI deduction on top of that, because it's kind of like, they really already got their tax cut, and it's set in, kind of set in stone until they do something for that. But other types of Schedule C's, Schedule E's even possibly could benefit from QBI.
Perfect. So we are out of time now. If you look at your screen here, we've got a little bit of information about those One Big Beautiful Bill consultations. If you'd like to take advantage of it, feel free to give us a call, shoot us a message. If you are new to Molen Associates, if you're starting a business, we offer free discovery meetings. We can learn more about your business, see how we can help you, see if we're a good fit. If that fits you, scan this QR code. I'd love to meet with you. It's a free 1-hour consultation, and we can basically just see if we're a good fit, see if we can help you. So it was great being with you guys today. As I mentioned, we'll send these slides and the recording afterwards, but thank you for your time today.
Thank you so much for joining us.